Listen, I want you to close your eyes for a second and imagine you're standing at a crossroads. In your hand, you're holding a briefcase with $50,000 in cash. This isn't just money, it's years of your life. It's the overtime hours, the missed vacations, and the disciplined saving. Now, you have two doors in front of you. Door number one has a giant sign that says VOO. It promises you the strength of the 500 largest companies in America. It's the old reliable of the investing world. Door number two says SCHD. It's the income machine. It promises to pay you more and more every single year, even if the world is falling apart. Which door do you choose? This is exactly where our friend Mark finds himself today. Mark has $50,000, and he's realized that leaving it in a savings account earning pennies is a slow death for his wealth. He's ready to build his secret money tree, but he's torn. Should he go for the maximum growth of the S&P 500, or should he focus on the rising dividend stream of SCHD? In this video, we aren't just going to look at some boring charts. We're going to run a full-scale simulation. We're going to put $50,000 into both, and we're going to fast forward 10, 20, and 30 years into the future. I'm going to show you the invisible math that most people miss, things like dividend growth rates and the power of reinvesting every single cent. By the end of this journey, you and Mark will know exactly which one of these ETFs is the right vehicle for your specific dream of financial freedom. So, let's pull back the curtain and see what happens when $50,000 meets the two titans of Wall Street. Let's start with door number one, VOO. If you've been in the investing world for more than 5 minutes, you've heard of the S&P 500. VOO is basically a slice of the American economy. When Mark buys VOO, he becomes a part owner of Apple, Microsoft, Amazon, and Nvidia. He's betting on the geniuses, the innovators, and the giants. Now, get this. VOO isn't trying to be fancy. It doesn't try to pick the winners. It just buys the 500 biggest players and lets them do the work. Historically, this engine has returned about 10 to 12% per year on average. But here's where Mark starts to hesitate. VOO's dividend yield is low, currently around 1.3%. For every $10,000 Mark puts in, he's only getting about $130 a year in dividends. To a guy like Mark, who wants to live off his portfolio, that feels, well, it feels a bit slow. But wait, don't count VOO out yet. Because what it lacks in immediate cash flow, it makes up for in raw, explosive growth. It's the total return king. And as we move through Mark's timeline, you're going to see why that growth is so hard to beat. Now, Mark looks over at the other door, door number two, SCHD. And honestly, this is where things get really interesting. If VOO is the engine of America, SCHD is the cash cow. SCHD doesn't just buy any company, it has a very strict set of rules. It only looks for companies that have paid dividends for at least 10 consecutive years and have the financial strength to keep growing those payments. We're talking about companies like Home Depot, Pepsi, and Chevron. The moment Mark looks at the numbers for SCHD, his eyes light up. Why? Because the yield is significantly higher, usually hovering around 3.4%. That's more than double what VOO offers right out of the gate. But the real secret sauce of SCHD isn't just the starting yield, it's the dividend growth rate. Over the last decade, SCHD has increased its dividend by an average of about 11% every single year. Think about that for a second. Imagine your boss gave you an 11% raise every single year, no matter what. That's what SCHD has been doing for its investors. Mark starts to visualize his money tree not just growing taller, but dropping more fruit every season. But is that enough to beat the raw power of the S&P 500? Let's find out. At this point, Mark decides to split the experiment. He puts $50,000 into VOO and $50,000 into SCHD. He turns on the DRIP, the dividend reinvestment plan, and we fast forward 10 years into the future. Let's check on the VOO account first. It's year 10. Mark's initial $50,000 has been riding the wave of the tech boom and the overall economy. Assuming a 10% average return, his portfolio has grown to roughly $130,000. His dividends have been reinvested, adding more shares to his pile. He's now receiving about $1,700 a year in dividends. Not bad, right? But he's still mostly relying on the share price going up. But now, let's look at the SCHD account. This is where the income snowball starts to show its face. Because of the high yield and that incredible dividend growth, Mark's $50,000 has grown to about $120,000. Wait, it's slightly less than VOO in total value? Yes, but look at the income. Mark is now receiving over $4,000 a year in dividends. That is more than double the income of the VOO portfolio. In year 10, Mark sees the trade-off clearly. VOO is the bigger pile of money, but SCHD is the bigger paycheck. If Mark needed to pay a few bills today, SCHD is winning. But the race is just getting started. Now, we hit the accelerator, we move to year 20. This is where the math starts to get a little crazy and where the snowball effect we always talk about really takes off. Back to VOO. Mark is now 50 years old in this scenario. His VOO portfolio has ballooned to nearly $340,000. It's a massive fortress of wealth. His annual dividend income has climbed to about $4,500. It's a nice supplement, but it's still not enough to quit his job. He's rich on paper, but his cash flow is still a bit thin. But then we open the SCHD statement, and Mark's jaw hits the floor. The total value is around $300,000, still trailing VOO's growth slightly. But look at the dividends. Because of that 11% annual raise we talked about, Mark's yield on cost has exploded. He is now bringing in over $15,000 a year in pure passive income. Think about that. In the SCHD scenario, Mark is getting a $1,200 check every single month, and he hasn't sold a single share. His money tree is now providing a significant portion of his lifestyle. VOO has given him more net worth, but SCHD has given him more freedom. Finally, we reach the ultimate milestone, year 30. Mark is ready to retire. He wants to walk away from the grind forever. He opens both accounts one last time to see which strategy won the war. The VOO results are staggering. His initial $50,000 has turned into nearly $900,000. It is a staggering amount of wealth from a single investment. His annual dividends are now around $12,000 a year, about $1,000 a month. It's a great safety net, but if he wants to live off this, he'll have to start selling his shares. And that makes Mark nervous. He doesn't want to pray for the market to stay up just so he can pay rent. And then he looks at the SCHD portfolio. The total value is roughly $750,000. Yes, he has about $150,000 less in total wealth than the VOO investor. But hold on, look at the dividend check. Mark is now receiving over $55,000 a year in dividends. That is more than $4,500 every single month. Let that sink in. In the SCHD scenario, Mark is earning more in dividends every year than his entire original investment. He has a $700,000 fortress that he never has to touch. He just lives off the fruit. He doesn't care if the market drops 20% tomorrow because his dividend check is safe and it's likely going to be even bigger next year. So Mark sits back and looks at the two paths. He's realized something that most people miss. The best investment isn't the one with the highest number on the screen, it's the one that matches your goal. If you are young, if you have a 30-year horizon, and you want to build the biggest pile of cash possible, VOO is your champion. It is the gold standard for total return. You can always sell some shares later to create your own income. But if you are like Mark, if you value cash flow over everything else, if you want the peace of mind of knowing that your bills are paid by dividends without you ever having to sell a single share, then SCHD is the undisputed king. It's for the investor who wants to see their paycheck grow every year, regardless of what the stock market is doing. For Mark, the answer was a hybrid. He realized he didn't have to choose just one. He put a portion in VOO for that explosive growth and a portion in SCHD to start building that reliable monthly paycheck. Choosing between VOO and SCHD isn't about which one is better. It's about which one gets you to your freedom number the way you want to get there. Whether you want the growth of the S&P 500 or the income of the dividend masters, the most important thing is that you start today. Because as Mark saw, the difference between starting now and waiting 5 years isn't just a few dollars. It's hundreds of thousands of dollars in lost compounding. Now, you know the power of these two ETFs. But what if you want to speed things up? What if you don't want to wait 30 years? What if you want to hit that target of $2,850 a month in just a fraction of the time? I have a very specific strategy for that. I've built a portfolio designed for maximum speed and maximum income. Click the video on your screen right now, the fastest way you can live off dividends, and I will show you and Mark the exact assets we use to fast track your freedom. I'll see you there.